The latest inflation reading is in. Headline inflation rose 2.3% year-over-year in April, slightly below the expected 2.4%. Headline inflation includes all items consumers buy, from gas to groceries to rent. That's different from core inflation, which strips out food and energy due to their volatility. Core inflation came in at 2.8%, indicating that the underlying price pressures remain persistent. What are the biggest drivers of inflation? Housing/rent inflation remains elevated at 4%. Food prices continue to climb. Energy prices dipped slightly, helping the headline number. Here's a graph showing the cumulative effects of annual inflation on prices in the last 20 years. Bread from $1 to $2 per pound since 2005. Chicken from $1 to $2 per pound. Ground beef from $2.50 to $6 per pound. Electricity from 10 cents per kilowatt hour to 17 cents. Here's an important caveat. Most of the data in the April 2025 report comes from before the recent tariff escalation on Liberation Day. The 10% blanket tariffs remain on goods from most countries. China tariffs were just reduced from 145% to 30%, with many exemptions. Still, that's higher than the 20% level before Liberation Day. And some of those new tariffs didn't go into effect until late April or May, so their impact is only just starting to be felt. Walmart's CEO recently said the company plans to raise prices due to tariffs on Chinese goods and on food from countries like Costa Rica, Peru, and Colombia. So what does this mean for interest rates? Despite the lower than expected inflation number, markets still expect the Federal Reserve to hold rates steady in June and likely July as well, according to the CME Fed Watch tool. President Trump, meanwhile, is pressuring Fed Chair Jerome Powell to lower interest rates. Why? One reason: interest payments on the federal debt are now costing the government $1 trillion annually, close to 14% or 1/7 of the federal budget. That's more than for defense, excluding veteran affairs. If rates were back to pandemic-era levels, which is about half of today's, that would save the federal government roughly $500 billion a year in interest on the debt. But pressuring the Fed might backfire. The Fed keeps rates high because inflation is still high. If you want to lower interest rates, inflation has to fall first, and tariffs tend to push it in the opposite direction. In essence, pressuring the Fed to lower rates is to deflate part of the debt away, meaning holders of US government bonds, cash, savings accounts, any type of fixed income assets would end up paying for the federal debt by having the dollars they hold devalued via inflation. What are your thoughts? Please comment below, like, share and subscribe. Thank you and see you next time.